I want to introduce Ellen Brown, who was at our last conference 5 years ago. And in fact, the Public Banking Institute was formed out of our last conference 5 years ago in Sonoma. Ellen Brown and Mark Armstrong met there and formed the Public Banking Institute there. So she's the co-founder and president of was president of the Public Banking Institute. And she developed her research skills as an attorney practicing civil litigation in Los Angeles, where she still lives. She is the author of 11 books, including Web of Debt and The Public Bank Solution, and she'll be signing them after her talk, because our break is right after the talk, where she traces the history and evolution of the current private banking system, and The Public Bank Solution, which details the way to democratize money. Ellen recently ran for treasurer of California on the Green Party ticket, as many of you may know. She got 5% of the vote in California, and I'm proud to say 10% of the vote in Sonoma County. So she has degrees from UC Berkeley and UCLA in law, and she's just been a wonderful advocate and worker for creating a public bank in California, and she did go to Mondragon with us too once. So please welcome Ellen Brown.
Thanks, Georgia, so much. Actually, I got 6.6% of the vote, but it was pretty hopeless anyway. But that was the most of any third-party candidate in the state. So there are no third-party candidates going on to election in November. They've gotten rid of us totally, so it's all Republicans and Democrats. So I guess I have a lot of slides, and I like them. It seems to me when you're talking about economics, it's so dry, and if you don't have something to look at, like a picture of a chart, you don't really, you need something to image it with. So we did form the Public Banking Institute. Actually, it was a year and a half after that event in Sonoma, but that's where I met Mark Armstrong, who was a great mover and shaker. And then pretty soon after that, we had 20 states with that had brought bills of one sort or another for publicly owned banks. We still don't have any publicly owned banks except for the Bank of North Dakota, but there's a lot of activity bubbling under the surface. For example, last week we had a seminar in Santa Fe where the mayor was one of our speakers, and he's really keen on setting up a publicly owned bank, and there was an attorney there who understood all the obstacles and still was heavily in favor, and we had council people and stuff. So we're actually getting a lot closer to understanding what obstacles we're meeting and how we can overcome them. And what I want to talk about are developments over the last 5 years, and which make public banking even more important than ever. And one of them was Thomas Piketty's bombshell book of 2013. It actually went to #1 on Amazon, which is amazing considering that it's 700 pages. It's about economics and statistics. I don't know how he did that. And it's $40. So it was #1 on Amazon. But what it did was it shattered the myths of capitalism, that using, proving it with statistics, that greed is not good. A rising tide does not lift all boats. Markets, if left to themselves, do not self-correct. In fact, what he got was a chart that looked like this. So this is the great divide between rich and poor. That first peak on the left is 1928. So you can see that was the greatest spread between rich and poor, and or income gap. And we had the 1930s collapse right after that. So then you had a stable period in the 40s, 50s, and 60s, and then the great wealth divide started again, and now we've got a gap between rich and poor that's even larger than in 1928. So it's clearly unsustainable. We're heading for trouble. This is another chart that came out of his figures. The little, you can barely see it on the left, the far left, that's actually 90% of the population It's the average income of the average increase in income from 2002 to 2012. So for 90% of the population, on average, income actually dropped by close to 11%. And then you can see the gains go increasingly over that 10%. But the real leap in gains is for the 0.01%. So highly unbalanced and highly unsustainable. If you read the paper, you see that this, or if you have stocks, you see that the stock market has been booming, although it seems to be dropping at the moment. But the wealth is all going to the top, while the workers' share is plummeting. I mean, that's a dramatically shocking chart. And so how did the 90% who are actually losing income, how do they make up the difference? How do they pay for the things they really need? They do it by borrowing. So this is the debt divide. The blue line is the top 95, or sorry, the bottom 95%, and the red line is the other 5%. So the blue section is their debt is rising exponentially. So the result is a debt overhang that is clearly unsustainable. In nature, things grow linearly, and you can't sustain an exponential curve. What went wrong? Why is the capitalist model not sustainable? We need to go to the root, as Lynn and Bill Twist were saying yesterday. The root to the problem, I would argue, is our money system itself. We need to redo our whole money system. So beginning at the beginning, where does money come from? Most people think it comes from the government. You would think that by looking at coins and dollar bills, which have pictures of presidents and kings and queens on them. But in fact, I won't try to explain this chart, but this is a chart of the money supply. And in fact, only about 3% of our money comes from coins and dollar bills. And you could argue whether dollar bills are even created by the government, since they're issued by the Federal Reserve, which is composed of 12 branches, all of which are 100% owned by the private banks in their district. So the question is, where does all the rest of it come from? If I can read this off my paper. I know it's deadly to read quotes off of a PowerPoint, I've been told that, but people just don't believe this, that money most of our money is created by private banks themselves. So that's why I throw in some compelling quotes. This one is from Robert B. Anderson, who was Treasury Secretary in 1959 under Eisenhower. He said, "When a bank makes a loan, it simply adds to the borrower's deposit account in the bank by the amount of the loan. The money is not taken from anyone else's deposit." So banks are not actually taking in deposits and lending them out. That's not what banks do. "It was not previously paid into the bank by anyone. It's new money created by the bank for the use of the borrower." So that's the power that we have given to private banks, and that's the power we need to get back. We need to get the profits for our own purposes, for the public purposes, and we need to be able to direct that power into where we want it to go and not into Wall Street speculation. And bringing it up to date, just last spring in the quarterly report of the Bank of England, they said, "Banks do not act simply as intermediaries, lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans." Again, that's what we want. That's the power we need to take back from Wall Street and give to our own public entities, to our own local governments. So they do it by double entry bookkeeping. If you go to the bank and you take out a loan, say for a mortgage for $500,000, the bank will write it up on one side of their books as an asset to themselves because you have agreed to pay that back over time. and then they write it on the other side as a liability to themselves because they are responsible for clearing that check when your check goes to the seller in some other bank. But they're not really responsible until somebody comes for their money. So all this money comes in as deposits. They count it as theirs. Legally, it is theirs, and all you have is an IOU. And their only responsibility is to come up with the money on demand. So on average, depositors only come for their money 10% of the time. So they've got this 90% of all this money that just seems to come in for free, and they can, since we've lifted the Glass-Steagall Act, since we've lifted Glass-Steagall, eliminated the divide between investment banking and depository banking, they can pretty much do with it as they will, except for certain regulations that limit that. And they get around those by going into the shadow banking system and the repo market. And all those figures, so that all came out to zero, and they will say, well, we didn't really create anything because plus 500 minus 500, it comes out to zero. But that the $500,000 check that goes to your seller, that becomes our circulating money supply. And all that is not taking into account the interest, which if you took out your loan at 6% over 30 years, you would pay another $580,000 in interest. So you would more than double what you owed to the bank over that 30-year period. Or even more alarming is compound interest. If you say on this lower chart, if you put your money, say you put $10,000 in the bank at age 20, this is what it used to be that your parents would coach you to do, you know. You'd put it in the bank at 6% and you just leave it there, and it would just keep compounding over time. Like you never took it out, it just kept adding to the pool that would attract more investment. After 40 years, by the time you retire, you would have $100,000. So the question is, where did that other $90,000 come from? It can really, since virtually all money is created as bank debt, it can really only come from from banks created as more debt. And where does that money go? I mean, some people will argue that, well, that the bank itself spends the interest back into the economy, so it's available to pay off principal and interest. But they really don't. Private banks, for the most part, their money either goes into more loans, so it's more money-making money schemes, or it's to pay off high-paid CEOs and other executives, and they put the money in offshore tax havens or invested in more money-making money schemes. So it's kind of like you put it out there like on a fishing rod with a little minnow, and then you take it back with a bigger fish. You're always taking back more money than you put out there. So it's an unsustainable system. It's pretty much a pyramid scheme where you have to continually be getting more, sucking in more borrowers at the bottom in order to sustain the lenders at the top. And oops, again, that only occurs in nature, in cancers, parasites, and compound interest. So what you get is a chart that looks like this, where it grows exponentially until the parasite runs out of its food source, and then it crashes. And that's what happened in 2008. So normally in a capitalist system, those big banks that couldn't get credit to pay off all the depositors that came for their money, or in that case it was actually the money market funds, they normally would just go bankrupt and would go out of business. But we broke the capitalist model. The government stepped in and socialized the losses by bailing out the banks, but the gains were still privatized, so they still went into the pockets of the big banks. But by 2010, Congress said no more. There would be no more bailouts, so they passed the Dodd-Frank Act, which President Obama came out on TV and said there'd be no more government bailouts, the problem is solved. But that didn't mean that they were going to let the banks go bankrupt. What is buried in there in more sort of discrete language, obscure language, is that these big banks are supposed to bail in their creditors' money, which means they will be converting debt to equity or recapitalizing themselves with their creditors' money. So the creditors, it turns out, are the bondholders, the stockholders, and the depositors, who are the largest class of creditor of any bank. We saw the effects in Cyprus, and that could well happen here. Again, as mentioned before, that it's actually the bank's money. Legally, when you put your deposit in the bank, it becomes the property of the bank. Those laws were passed in the mid-19th century. The banks at that time actually were fiduciaries that were supposed to keep your money safe, and then they would lend that money out, and so you had all the depositors sort of hovering over the bankers and saying, oh, that loan looks a little risky, I don't think you should be making that loan. And so the banker said, we can't operate that way, and the judge agreed, and so the rule became that when you put your money in the bank, it's the bank's, and all you have is the right to write checks on your deposit account and the right to demand your money. So you have a demand account, which means they have to come up with it on demand, but if they don't have it, they'll get it. The beauty of being a big bank is that you can borrow at 0.25% from the Fed funds market. That means you're borrowing from other banks, or at 0.15% from the money market. So you can borrow very cheaply, and you can borrow very quickly in a good, normally operating market. So again, that's a perk that we want. Our state and local governments should be able to borrow at 0.25% or 0.15% instead of having to borrow at 5% and worry about the bond vigilantes and interest rates going up and so forth, interest rate swaps, all those things that have been very costly and have gotten us in trouble. You might say, what about FDIC insurance? Doesn't that protect our deposits? It supposedly protects up to $250,000. But the fund, and this chart is a bit dated, but the fund actually today contains $47 billion, and the insured deposits are $4.5 trillion. All the deposits are over $9 trillion. So they're quite underfunded just for the deposits, and that's not taking into account this red line, which is the derivatives. Most of the derivative exposure of American banks is close to $300 trillion, and they're mostly in 5 big banks. So if one of those banks goes down, if they get into a big derivatives bust, like the 2008 one, those are the type that Dodd-Frank says we're not going to bail you out in the future. You'll have to bail in your depositors. So they'll be taking our money. And the catch is that under the Bankruptcy Reform Act of 2005, derivatives go first in a bankruptcy. So that means that they get to snatch all the collateral, even before the secured depositors, which would be the state and local governments. It's not really that they stand in line and go first. It's that the way the repo market works, they literally own the collateral. I mean, in the repo market, it's a bit complicated, but it's a sale and repurchase. So you sell say treasuries, you sell them overnight, and in the morning you buy them back, and you get a loan in return. Well, if the bank goes bankrupt overnight, the seller of that, or the buyer of that treasury, has got the goods, and so they just own it, and that's the end of it. They're not in the bankruptcy court. But what they are putting up as collateral is our money. I mean, they take our deposits, buy these treasuries with them, call that collateral, and then collateralize loans of their own that they can go bust on. So we need another system, and a sustainable system, and looking around at what might that be. Actually, I think the ideal model was invented or devised by the Quakers in Benjamin Franklin's day. The Quakers were bankers in England because, like the Jews, they were a discriminated against sect. They weren't allowed to go into business because they were so religious that they refused to pledge obeisance to the king, so they were considered traitors or suspected of being traitors. So they went into banking, but they had a different model of banking. It was a cooperative model where the whole idea was to serve the community rather than to sort of exploit the debtor. So in their model, this was at the time when the colonies were printing colonial script. They didn't have gold and silver, and the colonial governments needed to pay their soldiers and workers, and so they got this idea of they would pay them in these little receipts that were basically advances against future taxes. But the problem was it was a lot easier to print the little receipts and pay your workers than to get them back from these frontiersmen that couldn't necessarily be pinned down. So they tended to overprint, and in the northern colonies particularly, they tended to devalue the currency. But in Pennsylvania and several other colonies, they developed this model where the colonial government owned a bank. So it was called the land bank, but supposedly collateralized by land, but they didn't actually foreclose on the land. And the model worked something like this. I just made that up, but let's say they were using dollars. You would print $105. You could lend $100 at 5%. You could spend the $5 on roads and bridges and the things that the government or that the people needed and that they expected out of their government. So all that money would be out there to come back as principal and interest. So you would spend $100 or lend $100, spend $5, take back $105 as principal and interest. Lend the $100 all over, spend the $5 all over, take back $105 as principal and interest. So you could do that over and over without inflating the system. It was a sustainable system, and it actually was. During the period it was in place, the Pennsylvanians paid no taxes except an excess tax on liquor, which was more of a penalty tax. Prices did not inflate as a result of money, an increase in the money supply, and there was no government debt. So that system ended not because it was flawed, but because King George forbade the colonists to print their own money, and some authorities say that was a major cause of the revolution. We won the revolution, but we lost the power to issue our own money, which is a complicated story, but it's in my book, Web of Debt. So you might say, well, that was fine then, but you couldn't really run a government on today, just on interest, because the government's gotten too big and too complicated. But in fact, you could eliminate income taxes if you turned all of credit into a public utility so that the interest all went back to the public. These figures are from 2007, which was before the 2008 collapse, so it was when we had a thriving economy. The income tax that year was $1.3 trillion. The interest collected by all U.S. banks was $725 billion, and the interest paid on the federal debt was $451 billion. So assuming that the government had been borrowing all along from its own central bank so that either it paid no interest or it got the interest back, you could eliminate that 451 as well. Different countries have done that, like Australia, Canada, New Zealand in the first half of the 20th century. So that's a viable way to do it, a better way to do it, I would say. So that all comes to pretty close to 1.3 trillion. So you could pretty well wipe out income taxes just by turning credit into a public utility. In California, look at my chart here. In California, in 2013, general obligation revenue and other bonds came to $164 billion. Of that, $72 billion is for interest. So again, if we had been borrowing all along from our own state-owned bank, we would be $72 billion richer. So that's about 3 times the amount that we've gone over budget that Jerry Brown had to deal with to balance the budget. So we could have eliminated all those teachers that we laid off, all the tuition raises, the roads that have been left to get ruts and so forth. All that we could be back in the thriving golden age that California was in the 60s or so. I actually went to Berkeley in the 60s when tuition was free. And I went to UCLA in the 70s to law school, UCLA Law School, when tuition was $600 a year. So it's now $45,000 a year for an in-state student in a state school. So that's how much it's gone up. We could do that again. We could wipe out tuition, or letting our students go to university for free, if we had that $72 billion that we paid in interest over the years, or that we will owe over the years. These figures are from Margaret Kennedy, a German researcher who unfortunately passed away recently. And she got her figures from the Bundesbank, and she calculated that 35 to 40% of everything we buy goes to interest. You might say, well, I don't pay interest, I'm not in debt. But what she's talking about is the interest on paid by all the companies in the chain of production of a product. So if you have a complicated product, each one adds their little mite, and then they sell it to the next company in the chain for adding on their cost plus a little profit. So those companies have to pay their workers and materials before they have a product to sell and before they collect 90 days net or whatever it is. So it used to be they would fund themselves on a credit line, like 8% credit line from the bank, but now the banks are cutting back on those credit lines. So they're actually having to go to credit cards at 16%. So that's a huge portion of their cost is added on at each stage of development of a product. So by the time you get to the end product, it comes to 35 to 40% of the cost of the product is interest on average. And she calculated that 40% of public projects goes to interest. So if we own the bank, we would be able to save that virtually half the cost of infrastructure. And you can see that in, for example, the Bay Bridge retrofit, which was just finished and looks lovely. It was supposed to be $6 billion, but when you add in interest, it will be $12 billion. And the bullet train, Jerry Brown's pet project, the initial outlay approved by the voters was close to 10 billion, but when you add in interest, it will double the cost, so close to 20 billion, and that's just the initial. I mean, I've seen estimates as high as 100 billion. But anyway, interest is a huge chunk of what we pay for infrastructure. If we borrowed from our own bank, we could save those costs. And it's liable to get worse because as of September, the Federal Reserve has come out with new rules saying that the largest Wall Street banks are required to keep a month's worth of what's called high-quality liquid assets on their books. But excluded from that category are the municipal bonds. So that means these big banks are liable to be dumping their municipal bonds in favor of things that are included, which would be treasuries, corporate bonds, certain corporate bonds, and certain corporate stock, but not municipal bonds. So that's liable to drive the interest rate up because they have to go to the open market in order to find buyers. So this chart is from the Eurozone. You can see what happened. The blue is that big peak was Greece. If you have to go out on the open market and you can't find buyers, you might have to raise your interest rates to something like that. Or even these lower rises could easily bankrupt our state and local governments. So they'll be in the position of Detroit, where they could be forced into an involuntary bankruptcy. In fact, some people, suspicious minds, might argue that that was the whole plan to privatize everything and to force out our pension funds and force our state and local governments into bankruptcy. So how can we fix all that? By owning the bank. We can save all those interest costs by owning the bank, and we can have a much safer place to put our revenues where we don't have to worry about interest rates, we don't have to worry about bail-ins, et cetera. This is obviously not a new idea globally. 40% of banks globally are publicly owned. I was shocked to find that myself. I was just looking for other models besides the Bank of North Dakota, since people say Bank of North Dakota, or North Dakota has oil. So I just started looking globally. 40% of banks globally, and they tend to be in the BRIC countries, Brazil, Russia, India, and China, which house 40% of the global population and which escaped the credit crisis, at least in the beginning. But also in Germany, Japan, Korea, a number of very successful models of public banking. So in the US, we have one, the Bank of North Dakota, but North Dakota also is the only state that escaped the credit crisis. By 2009, it was still in the black when every other state had slipped into the red, and that was when I started writing about it, because I knew they were the only state that had their own bank, and that was before the oil boom, which really didn't hit until 2010. They have the lowest unemployment rate in the country, the lowest default rate on credit card debt, and one of the lowest foreclosure rates. In North Dakota, unlike in, say, China or some of these other Southeast Asian countries, it's not about socialism, it's about state sovereignty. In 1919, the farmers were losing their farms to the Wall Street bankers, and so they banded together, formed the Nonpartisan League, neither left nor right. It was about state sovereignty, and got this bank established and pulled their money out of Wall Street, put it in their own bank, and it's been doing very well ever since. The North Dakota model is that by law, all of the state's revenues are deposited in the Bank of North Dakota, and it's set up as North Dakota doing business as the Bank of North Dakota. So technically, all of the assets of the state are the assets of the bank. So it has a huge capital base and a huge deposit base, and this allows it to make credit available as needed in its own local economy. They don't compete with local banks, they partner with them. So the local bank is sort of the front office that goes out and deals with the customer, finds the loans. But the Bank of North Dakota comes in and they might participate, say, in 90% of the loan. So they allow these small banks to make much larger loans than they would otherwise. They allow projects to be funded that are local projects that are much needed, but Wall Street has no interest in them, and the local banks by themselves would be too small to fund them. So it's a very successful model, and it's very lucrative for the state. They've returned $40 million annually over the last decade to the state coffers, and they have had a return on equity of 17 to 26% since 2008, that is, since the credit crisis. And one reason they can be so profitable is that their costs are low. They don't pay bonuses, fees, commissions. They don't have branches. They don't have ATMs. They just have the one branch in the capital city, and they have a couple, like 2% or so of their depositors are individuals, but they don't encourage that. They just do it because they figured, well, they're a public bank, they should make it available to the public. But it's really a place for the government's own money to keep that money safe and to leverage it for the purposes of the state itself. And one advantage, among others, is that they don't have to maintain rainy day funds. The one time that they did go over budget in 2001, the state just issued themselves an extra dividend through their own bank, and the next year they were back on track. They didn't have to borrow, they didn't go into debt, they didn't have to bow to Wall Street. So this is a summary. In summary, this is what you can do with your state-owned bank. You can save 40 to 50% on the cost of infrastructure. You can protect your state revenues from bank runs and bail-ins. You have a readily available source of credit for the local community. And among other perks, you can have prompt, efficient disaster relief, as was demonstrated in North Dakota in the Grand Forks flood of 1997, for example. But the point is that it's there to serve the public interest, and it does serve the public interest. As they say, we're not saints, and there was a German a man who came from the German banks who spoke at our conference last week, and he said, we're not saints. It's just that the laws are such that they don't have the opportunity to go outside these lines. I mean, in order to have a sustainable system, what you need is rules that keep banking serving the public and not doing these things that are extortionate to the public. Studies have found that publicly owned banks are actually less corrupt, more efficient, and surprisingly more profitable than private banks, even though they're not trying to be more profitable, but it's just because they have all these advantages, the lower costs, and they have the government backing them up. They lend countercyclically, which means they make loans into the community. When other banks are pulling back on credit, the public banks have a mandate to go out there and issue more credit. You can see that particularly in China, which after the 2008 crisis, they went out there and just were lending to everybody in sight in order to keep their economy booming, which did work. So we have 20 states have introduced bills. The one that has gotten the farthest is California. It passed both houses of the legislature 3 years ago. But Jerry Brown wouldn't sign it. It was a bill for a feasibility study. He said, we don't need more committees. We have plenty of committees. We can do this in-house. But they didn't do it. They haven't done it. So what we need to do, the door has been opened, but what we need to do is push them through. We need a mass movement. And it seems to me that none of these little movements are large enough by themselves to really prevail, but we are the 99%, which means by definition, we've got the numbers. They've got the money, we've got the numbers. So if we can get the 99% together, say on all these different things that we all generally agree with, we can, there is a problem about arguing about the details, but if we could just skip the details and go with the broad front and get organized as one broad movement, I think we have a great chance of prevailing, particularly if there is another banking crisis. Never waste a good crisis, as they say. So that's it. These are my websites, publicbankinginstitute.org for information on how to set up a public bank, where to go to find other people working on it in your area. And my blog, ellenbrown.com, has over 200 articles on it, on this subject. And then these are my books, Public Bank Solution and Web of Debt. Thank you very much.
Thank you, Ellen, and I'm going to highly recommend her books. Web of Debt was just so fascinating. It's the history of money, the history of banking. You read that book, you study that book, you don't just read it, because you'll understand so much more about what we need to do with money and banking in this country and actually internationally. So I don't think anyone should leave here without that book.